Want to unlock the secrets to building real wealth and achieving financial freedom? It all starts with saving and investing. Let's dive right in. Hey everyone, welcome back to our channel, Work, No Skills. Today, we're talking about how to generate wealth in a way that you can't lose. This strategy allows you to become rich and retire early without worrying about your future. By the end of this video, you'll know exactly how to get started and why it's crucial to have a plan and follow through. I will explain everything, so let's get to it. First, let's clarify what we mean by wealth. Wealth isn't just about having a high income or a fat paycheck. It's about accumulating assets that generate income and grow in value over time. True wealth provides financial security and the freedom to live life on your terms. Now let's talk about investing, the real powerhouse behind wealth generation. Investing is all about putting your money into assets like stocks, bonds, or real estate with the expectation that their value will grow over time. This isn't just stashing cash away, it's making your money work for you. Before we dive deeper, a quick disclaimer. I'm not a financial or investment advisor. This video is for entertainment purposes only and reflects my personal opinions. Always do your own research or consult with a professional before making any financial decisions. So, what's the difference between saving and investing? Saving is setting aside money for future use. It's safe and easily accessible, like money in a savings account. The downside? Savings typically earn very low interest, which barely keeps up with inflation. Investing, on the other hand, involves more risk, but offers the potential for much higher returns. While saving is crucial for short-term goals and emergencies, investing is essential for long-term wealth building. Let's break it down further. The pros of saving: low risk, liquidity, and stability. The cons of saving: low returns, inflation risk. The pros of investing: higher potential returns, compound interest, and long-term growth. The cons of investing: market risk, requires research and time to grow. Both saving and investing are important, but they serve different purposes. For instance, you need savings for an emergency fund, but investments for retirement. Now, some of you might confuse investing with trading. Trading involves buying and selling financial instruments like stocks or cryptocurrencies, frequently to profit from short-term market movements. Unlike investing, which focuses on long-term growth, trading is more about timing the market. While trading can be profitable, it's also riskier and not suited for everyone. So, how do you get started with investing? First, educate yourself. Understand the basics of different investment vehicles and how the stock market works. Then, choose an investment account like a brokerage account or a retirement account such as an IRA or 401k. Diversify your portfolio to spread risk and consider starting with low-cost index funds or ETFs, which offer broad market exposure. Let's put this into perspective with an example. Suppose you start investing when you get your first job at 22 right after college. You invest $200 a month in your 20s, $400 a month in your 30s because now you have a better job. And then you invest $800 a month in your 40s because you are at the peak of your career. All that money you put into an S&P 500 index fund every month. Historically, the S&P 500 has returned about 10% annually over the past 30 years. After 30 years, and by the time you're 52, here's how much you could potentially have. In your 20s, $200 a month for 10 years equals $38,727. In your 30s, $400 a month for 10 years is a total of $126,620. In your 40s, invest $800 a month for 10 years equals $409,986. Total, $575,333. More than $500,000 that will contribute to your early retirement. That's the power of compound interest and consistent investing over time. Your money grows exponentially, and the earlier you start, the more you benefit. To maximize your saving and investing efforts, consider these: compound interest, dollar cost averaging, setting financial goals. One big ask before we proceed. If you like this video, please give it a thumbs up and subscribe to our channel for more money-making tips. Your engagement helps a lot with the YouTube algorithm. Compound interest is one of the most powerful tools in building wealth. It means you earn interest not only on your initial investment, but also on the interest that accumulates over time. Think of it as earning interest on your interest. For example, if you invest $1,000 at an annual interest rate of 10%, you'll have $1,100 after 1 year. In the second year, you earn interest on $1,100, not just your original $1,000. This continues, and over time, this compounding effect significantly boosts your investment's growth. Let's take this example further. Here's how your investment of $1,000 would grow over 5 years with compound interest. Year 1, $1,000 plus 10% of $1,000 equals $1,100. Year 2, $1,100 plus 10% of $1,100 is $1,210, and so on and so forth. By the end of 5 years, your $1,000 has grown to $1,610. That's the magic of compound interest. Your investment grows faster as time goes on, without you having to add any more money. Dollar cost averaging is an investment strategy where you consistently invest a fixed amount of money at regular intervals, regardless of the market conditions. This approach can help reduce the impact of volatility and lower the average cost of your investments over time. For instance, let's say you decide to invest $200 every month in an S&P 500 index fund, like VOO Vanguard S&P 500 ETF. When the market is high, your $200 buys fewer shares, and when the market is low, it buys more shares. Over time, this averages out the cost of your investments, potentially reducing the risk of investing a large amount in a single instance when prices might be high. Here's an example to illustrate this. In January, the price per share is $50. You invest $200 and buy 4 shares. In February, the price per share drops to $40. You invest $200 and buy 5 shares. In March, the price per share rises to $60. You invest $200 and buy 3.33 shares. By March, you've invested $600 in total, and you own 12.33 shares. The average cost per share is $48.65, which is lower than the highest price of $60 you encountered. Dollar cost averaging helps smooth out the effects of market fluctuations and can be particularly beneficial in volatile markets. Setting financial goals is essential for effective saving and investing. Clear goals provide direction and motivation, helping you stay focused on your financial journey. To set financial goals, follow these steps. Define your goals. Identify what you want to achieve. This could be building an emergency fund, saving for a down payment on a house, funding your child's education, or planning for retirement. Make your goals specific and measurable. Rather than vague goals like save money, specify the amount you want to save and the time frame. For example, save $10,000 for a down payment in 2 years. Break down your goals. Divide your goals into manageable steps. If your goal is to save $10,000 in 2 years, determine how much you need to save each month. $10,000 divided by 24 months is approximately $417 per month. Track your progress. Regularly review your progress towards your goals. Adjust your plan if needed to stay on track. Let's look at an example. Imagine you want to save $20,000 for a home down payment in 5 years. Here's a simple template to follow. Goal: save $20,000 for a home down payment in 5 years. Monthly savings target: $20,000 divided by 60 months equals approximately $334 per month. Action plan: create a budget to identify areas where you can cut back and save more. Set up an automatic transfer of $334 from your checking account to a dedicated savings account each month. Regularly review your budget and savings progress to ensure you're on track. By setting specific, measurable, and time-bound goals, you can create a clear path to financial success. Avoid these common pitfalls. Not having an emergency fund. Ensure you have savings to cover unexpected expenses before diving into investing. Emotional investing. Don't make decisions based on market hype or fear. Stay informed and stick to your strategy. Lack of diversification. Spread your investments to minimize risk. Debt. Avoid having or growing your debt. Pay back any loans to avoid a growing debt due to high interest. Now, to wrap up, generating wealth is a journey that requires both saving and investing. Start with a solid savings foundation, then gradually introduce investing to grow your wealth over time. Remember, the key is to start early, stay informed, and remain consistent. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more financial tips, and leave a comment below. We'd love to hear from you. Thanks for watching. See you next time.